Good morning and welcome to the CEFC Green Room webinar today. This is in fact our seventh Green Room. We've covered a broad range of topics over the course of those webinars, and I'm very pleased today to have Rupert, Maloney, our Head of Hydrogen, here today to talk all things hydrogen. Firstly, I want to acknowledge the traditional owners of the country upon of the land upon which we are based here in Sydney, the Gadigal people of the Eora Nation, and acknowledge their elders past, present and emerging. At the end of the webinar, you as audience members are feel free to ask questions. We'll try and get to those questions. There's a Q&A box, and hopefully you'll have time for plenty of interaction with you. There'll also be a short questionnaire at the end, and if you get an opportunity to answer that, we appreciate your feedback. So today, as I say, we're exploring the potential of hydrogen in the clean energy transition, and the contribution that it can make. We want to, of course, reduce emissions across Australia over the coming years, and hydrogen, of course, is seen as a very critical and important factor, transitional fuel as part of that, and it could well be a great new export industry for the country. We're going to talk a little bit about a study that we've undertaken, a research report, the Australian Hydrogen Market Study, which we commissioned Advisian, part of the Worley Group, to do a very comprehensive and very commercial undertaking and research of the potential of the Australian hydrogen market. And you can access a copy of that particular report in your resources box, which is on your screen. So have a look for that. We'll talk a little bit to it throughout the course of this webinar. Rupert, morning, welcome.
Thanks, Ian.
Yeah, terrific. Now, we've got a very diverse range of attendees out there. We've got there's been a fantastic response. Of course, hydrogen is very much the topic of the minute. I wonder whether you might start by briefly explaining the importance of hydrogen in the clean energy transition.
Yeah, sure, Ian. So maybe if we go back to first principles, because there is a lot of excitement at the moment about hydrogen, but hydrogen is currently used across the energy system, but it's a pretty niche application. It's predominantly used as an industrial feedstock, mainly today in the ammonia and oil refining industries. It's mainly produced globally from natural gas, so from a process called steam methane reforming. But the challenge with that process is it's a large carbon emitter. I think I've heard the numbers about 3% of global emissions comes solely from that production of what's called grey hydrogen through that ammonia process, or as an input into oil refining. But the excitement really is driven around that there's another way of producing hydrogen, and that's what's called renewable hydrogen or green hydrogen. And that's essentially taking renewable energy through a device called an electrolyzer, which essentially splits water to its two parts, being hydrogen and oxygen. And so when hydrogen is produced in that way, it has zero emissions. And then that hydrogen is an energy vector or an energy carrier, and that green hydrogen can be used in those same processes that hydrogen is used today, but it can also be used across the energy system, and that's what's driving a lot of this excitement. So you can use that hydrogen to enable that large-scale renewable energy. It's a very flexible source, so obviously renewable energy being a variable energy source, hydrogen can play off that. And then you can also distribute that energy across sectors and regions, and then use hydrogen in multiple end-use applications. And the study that we've done with Advisian looks at some of those end-use applications. So we'll step into those in a little bit.
Thanks, Rupert. That's very informative. And as you say, hydrogen is very much a hot topic at the moment. We're hearing a lot about it. I thought maybe I might talk for a few minutes about our role in the hydrogen sector and some of the things that we're doing to support the industry. And people may know that the government have instructed us to devote $300 million to an advancing hydrogen fund, and we're going to talk a little bit about that later this morning. ARENA, as we know, are also making substantial grant-based investments in the sector as well. So there's quite a bit of activity going on. I mean, the CEFC, of course, as a major investor and financier in the broader clean energy sector, particularly in renewables, wind and solar, that will be, of course, a very critical, important part of the hydrogen, the whole hydrogen story, because at the end of the day, we're trying to use renewable energy to drive the electrolyser process, and we've, of course, have many years supporting those sectors. So I see us playing a very significant kind of role. It's also very exciting today to announce on behalf of the CEFC that we've made our first investment in a hydrogen company, in fact, a hydrogen sort of technology investment, if you like, through our Clean Energy Innovation Fund, which is our $200 million, effectively clean tech fund, and they've made about 19 investments over the last 4 or so years. But we're announcing today, and hopefully you'll read a bit more about it in the press. We've invested $750,000 in Australian research. Well, in Australian research. It's been commercialised. Electrolyser research. It's been commercialised out of the University of Wollongong, and it's part of a bigger capital raise, a $5 billion capital raise, and the company is called HySATA. And it is developing this very efficient electrolyser technology, and the efficiency of the electrolyser is a very, very important part in ultimately determining the cost of production of hydrogen. It's a combination, of course, of the cost of electricity, but the process of or the efficiency of the electrolyser is absolutely fundamental to the economics. And we've invested alongside IP Group, who were the lead investor in the round. And as I say, it's technology that's being developed out of the University of Wollongong, particularly being led by Professor Jerry Sweegers, and we absolutely, it's just fantastic and honoured to be kind of investing in some of Jerry's work here. Professor Sweegers has in fact already has a tremendous track record in this area. He's founded 6 spin-off companies, licensed a lot of new technologies over 15 years. I think has attracted over his kind of time more than $100 million of investment into the commercialisation of his research, and in fact has won many awards, including the DuPont Innovation Award for taking ideas to market. So you'll hear more about that, but as I say, today we're announcing the CEFC's first actual investment in the hydrogen market. We're now going to talk a little bit about the report that I touched on earlier. As I say, there's a lot of information out there, Rupert, isn't there, about hydrogen? Many reports, lots of research from around the world. But we commissioned something that was very focused on the Australian market and what might be the key commercial levers, and where we might, as an investor with lots of capital, where we might find investable opportunities in the hydrogen market. So I wonder whether you might tell us about the report and what it's kind of helping us achieve.
Yeah, happy to. So it's a report we worked with Vizian, a global leader in this space, over a long period of time. And what we're trying to do is really understand the economics and the commerciality, as you mentioned, Ian, of a whole range of different end-use applications. So we started with the hydrogen production cost. So a real focus here on green hydrogen, what I mentioned before. And we took the key inputs in that production cost, mainly being the capital cost of the electrolyser, the efficiency of the electrolyser, and the cost of the renewable energy. And we looked at those today and then over time to come out with a farm gate cost. So that's essentially the production cost of hydrogen. But that's only half the story. And we then looked at, well, where would that hydrogen production be located in Australia? Would it be close to the renewable energy source, or would it be close to the demand centre? So we ran some different scenarios and factored in that distribution cost. Then to get to a delivered cost of green hydrogen. And then, and that varies across lots of different end-use applications because that supply chain cost will vary. And then we compared it to the alternative technology. So that's the technology which exists today. So, for example, diesel in internal combustion engine vehicles, or natural gas, or other hydrocarbon-based fuels. And then, so that's the framework of the study, to really understand those economic gaps over time. And so if we look at some of the outputs of the study and at the production cost level, we mapped, as you can see on this chart, which is on the screen. And if you need to expand it, you can expand it, I believe, in the top corner. We mapped that green hydrogen cost versus grey and blue. So grey is what I mentioned before, which is the current way of producing hydrogen mainly through steam methane reforming, large carbon emitter. And blue is an alternative low carbon way of producing hydrogen. So this would be taking the grey hydrogen and using CCS, or carbon capture and storage, to sequester the carbon emissions. The challenge there is that there is a cost there above the grey hydrogen because it does cost to capture and transport that carbon. And this analysis from Envisian came out with the conclusions that green certainly is the highest form of highest cost hydrogen today. However, there's a clear pathway for green to become competitive with the other forms of hydrogen. In around about 10 years' time, so around about 2030, there's a pathway for green to be cheaper than blue. Blue is very and green is as well, but blue is very locational specific. So the cost is very dependent on where that blue is produced, because you need to sequester the carbon. And then there's a pathway for green to be competitive against grey hydrogen between about 2030 to 35 to about 2045, depending on the assumptions that you assume for your capital cost of your electrolyzers. So there's a clear pathway. So we took those inputs, those production inputs, to then, as I stepped through before, to come up with a dispensed or a delivered cost of hydrogen, and then compared it to the alternative. So hopefully now on the screen you'll be seeing the economic gaps, which are essentially the conclusions from the report. And we can probably talk about it in 2 or 3 different categories. One being transportation. So this is essentially displacing diesel or petroleum products. There's definitely a really clear pathway for hydrogen fuel cell vehicles to be competitive. And by competitive, we didn't just compare hydrogen versus diesel and their energy contents and their costs. We did a full total cost of ownership analysis, which is quite important because obviously a hydrogen fuel cell vehicle today isn't the same cost. It's more expensive than the equivalent diesel or internal combustion engine vehicle. And so we factored those in. We factored in changes in total cost of ownership over time to come up with that in some end-use applications, certainly in line haul trucking or return to source, heavy vehicles, there's a pathway for commerciality. And so that's pretty exciting that we can see that. The next group is what I sort of think about as displacing natural gas. So that's fuel for industry, or ammonia calcining, or steel, or aluminium calcining. And this is where natural gas is the energy source used, or the carbon source in some applications used in those processes. There's no doubt the report brought out that the economics are more challenging in those end-use applications. And it really comes down to the thermal value of natural gas versus hydrogen. One key point that the report brought out is that at $10 per gigajoule in natural gas equates to about $1.20 per kilogram in hydrogen. So even at $2, there potentially could be an economic gap. However, some of those processes like ammonia and steel, it's not just a pure thermal evaluation. You need to take into consideration some capital costs. But there's a challenge. But that's not to say that that there's not a role there for hydrogen. Certainly, hydrogen is one of the key pathways for decarbonising some of those end-use applications, and they are big carbon emitters. Steel is in the order of 8% of global carbon emissions, comes from the steel-making process. So with carbon being probably the forefront application to decarbonise, so we shouldn't be worried or challenged by that economic gap. We need to take it on and come up with new technologies, and a lot of this will be technology led. Like this investment we've announced today is all about that technology and bringing down that cost of green hydrogen and step changes. The last section we also did cover, which isn't on this slide because there's not really an alternative today, but is the opportunity for export. There's a lot of focus in the export markets, and we in the report outline the economics of that. We're once again challenged, but not to say there's not a pathway for export to be a viable industry in Australia.
Thanks, Rupert. I'm just conscious of the broad range of the audience there. I just wonder whether you might explain thermal value,
sure, what
that means, because that's a very key distinction and helps, sure, the gas versus hydrogen question.
Yeah, sure. So natural gas being used, most of the time it can be used as an input, but most of the time it's burnt. So you burn it through a furnace to create high heat, and the energy is used through that burning process. For example, a gas turbine to create electricity is a good example of that. Hydrogen has similar properties, not the same. There are differences, no doubt about that. But you can also burn hydrogen in a similar way to natural gas and use it through similar applications. There are some, when you get pure hydrogen versus pure methane or natural gas, there are some changes that may need to be made to the infrastructure, but you can essentially do a lot of the things that you do with natural gas today. But the challenge is the energy content is different, and the density as well of natural gas is different to hydrogen as well. So, and natural gas is more dense, so you can carry the same amount of energy content over a smaller pipeline, or you need less of it. Yes. Hydrogen is less dense, and you need more of it for the same amount of energy that you're seeking.
Thank you for that. And look, that's also been a challenge with the electrification of industry as well. Gas, as you say, has that incredibly high thermal value. So we need to displace it over time. How do we get competitive fuels like hydrogen to meet that? That's great. Look, I would encourage people to have a look at that report. It's lengthy, but there's great summaries up the front, and there's some terrific graphs bringing out some of these what I think are the key issues in terms of the commercial features and of hydrogen over the coming years. And when we kind of look at some of the findings there, Rupert, in the report, and it does talk about, I guess, what might be the priority sectors. Heavy transportation and heavy trucking in the mining sector and so on. Does that mean that you think we should just put all our attention in that direction? And we leave this sort of displacement of gas aspiration?
No, I don't think so. I think that it's this interesting balance, and it's something that we think about a lot when we look at projects. But there's certainly a role for blending hydrogen in the natural gas grid, or for ammonia, for displacing grey hydrogen in the ammonia production process. And a lot of that's driven by today there is volume, there's a demand, there's a deep demand source for hydrogen in those applications. there's not that deep demand source for hydrogen in transportation. There's other challenges in transportation, which we might get to. But there's that deep demand source today. And how are we going to bring down, and there's a big focus globally on bringing down green hydrogen costs. We're going to do that through scale. There's no doubt about that. And in order to get to scale, we need to utilise some of these deep demand sources. And there's a decarbonisation opportunity as well. That use of natural gas in the natural gas grid, or ammonia, is a high carbon emitter. So there's certainly benefits. And the other thing to note as well is the supply chains are a lot more straightforward in those applications. The way I think about it is natural blending in the natural gas grid. You can literally put and some projects are currently looking at doing this, put an electrolyser very close to an injection point, and blend up to around about a 10% blend quite easily. You don't need storage because you are just blending. So you can actually run that electrolyser off variable renewable energy and produce that hydrogen, and as you produce, you blend. So it's a relatively simple supply chain, which is lower cost as well. So while that thermal value is a challenge, no doubt about that, the supply chain is a lot more simpler and lower cost than transportation, which is the thermal value of versus diesel is different, yes. But the supply chain's more complex. And one last point as well is that some of these applications we're talking about, there's not a key alternative to decarbonisation. So steel is a good example of that. As I said before, it's a large emitter. Hydrogen is one of the key avenues to decarbonise that industry. We can't just give up and say the economics are too difficult. We need to start building that scale, bring down green hydrogen costs, and so there's opportunities there.
No, absolutely. And look, it's like a number of these sectors we have to make the investment in, even though, yes, there's economic challenges. And that's where, the CEFC, I think, has a role to play, be it providing concessional finance. ARENA has a role to play with some grant funding, kind of improving these supply chains going in. And we've seen it in the, with the emergence of the utility scale solar sector out there. We work with ARENA. The economics were tough and challenging, and people probably thought, maybe that was a bit hard. But of course, over time, learning curves come down and things become economic. So, I think that you're absolutely right. We have to invest not just in, what might be the more obvious initial sectors. And just on those, Rupert, we're talking about transportation, trucks, maybe, hydrogen buses and so on. If they are near commercial, why aren't we seeing many of those transactions today?
Yeah, sure. It's a good point, because I always think about that as we put out this report, which says trucking is commercial today or close to being commercial, and then a key question they can come back and say why can't we see those projects? And we are pushing for those projects. We're certainly encouraging those projects, and we're seeing a lot of those projects out there in Australia. But the challenges that we see is the first one is vehicle availability. This is a similar challenge that has played out in electric vehicles. That you've got OEMs, so the producers, the manufacturers, the global manufacturers of trucks, which aren't there yet. They're not producing hydrogen fuel cell trucks. They're encouraged, and they're spending money on R&D, and hopefully they will produce in the future, but they're not there yet. We're seeing some new businesses come into that fold, not too dissimilar to what's happened in the EV world with Tesla. Some businesses that are solely focused on hydrogen fuel cell, and that's encouraging. A number of those businesses are raising capital globally and are starting to roll out vehicles. So there's some Australian projects that are targeting those manufacturers, but that is a challenge, availability of vehicles. And then what I sort of touched on before, the supply chain. So the report assumes not a fully utilised supply chain, but it makes some assumptions on the utilisation of those supply chains when we come out with those conclusions about trucking. And that's difficult for a project because it's this chicken and egg problem and the demand versus the supply production side. So a lot of the early projects that we're starting to see will be what I call fully captive projects. So you have a producer who's producing for their own use, and they're building supply around that their own use. So I think that'll be the first movers. And then the other thing, it's competing against a highly efficient. The downstream petroleum industry is highly efficient. It's been built over more than a century. You have a fuel station on most corners. It's competitive, but from production all the way to dispensing fuels is an efficient supply chain. And it's flexible as well. You can drive a truck and you're not worried about where you're going to fill up that truck, and you have your fuel card from a different fuel provider, and you don't need to sign up to long-term arrangements. I think some of these earlier transportation projects will require long-term commitments from customers because you're building a 20-year asset, and you need to have some level of certainty. Certainly from a financing or a bankability perspective, you need to have some level of certainty that the asset's going to be used. So you need customers to be more flexible in the sense that they're willing to provide that long-term commitment. So I think we need customers early on doing that. So I think there's some of the challenges, but we're really keen from a CEFC perspective to work through those challenges through our financing products.
That's absolutely. And I think we will see that probably first, as you say, maybe in the resources sector, where it's a bit, that the transportation is somehow kind of inextricably connected to the process or the mining that they're doing, and then it'll be much further down the track that we see hydrogen trucking or hydrogen cars out there in the field, if you like. Because, there are no hydrogen refuelling stations. I know that Chief Scientist Alan Finkel's waiting on his hydrogen car, but he was saying there's only one refuelling station in Melbourne for hydrogen today. So that's going to take a while. I want to talk about the export industry, because you hear a lot about that. It's obviously a very exciting longer-term proposition, and there are these huge projects like the Asian Renewable Energy Hub, up there in northwest Australia, that was originally, I think, going to export electrons to, of course, to Singapore and overseas, using our incredible abundance of renewable energy, particularly solar, up there in that part of Australia. They've kind of moved their strategy now to, they have extraordinary ambition around becoming a green ammonia export of 10 million tonnes per annum, I think, is what they're hoping to ultimately export. So we're hearing a lot about that. Every state in Australia's got designs on, ultimately leveraging it off their old LNG business, or they've got their competitive edge and they want to start exporting green hydrogen, green ammonia to Asia. Tell me about that. How hard is that? How real is it?
No doubt it's hard. And the report does go into this. We map out the costs, the fully delivered cost to, I believe we choose Japan as the end use market, just as an example. And it paints a challenging picture. Certainly today it's at a material premium to the alternative. So obviously hydrogen, you could export hydrogen in liquid hydrogen format, and there's a project underway at the moment out of Victoria actually to Japan, where they've got one liquid hydrogen ship, which is really proving up that supply chain, but very expensive. It's more difficult than LNG. You need to go down, freeze it down to below 250 degrees or negative 250 degrees. And so it's expensive and difficult, not to say that projects aren't looking at that. Ammonia is another form. It's a tradable commodity today. So there are ships that move ammonia around the world. So there's an opportunity there for to replace that with green ammonia. But there's no doubt that the costs are a material step up to those alternatives. So grey versus green ammonia is a good example of that. However, we're starting to see some changes, certainly from the customer markets. Certainly as these customers have all committed to net zero, Japan and Germany and the Europeans, a career as well. So they're mapping out what 2050 looks like, and a lot of these markets will need to be net importers of energy, and the main two ways you do that will be either a transmission cable, which is difficult out of Australia, or potentially through ammonia or liquid hydrogen is another format that you could do that. So they're mapping that through. And I think the way I look at it, I'm hopeful at least that we will start getting a dislocation of markets. And by that I mean that there will start getting green premiums paid for the low carbon product. It doesn't exist today, but certainly the federal government's working on a guarantee of origin scheme, which will really help that. And by a guarantee of origin schemes means that you can start certifying the amount of carbon within that hydrogen. So whether it's blue or green or grey, essentially there's a stamp on it which says how much carbon, so then the customer can choose, and that will allow for customers paying a premium for the lower carbon version. And so we're starting to see customers talking about this. And then border adjustment taxes is another one that is topical at the moment.
That's true.
And the guarantee of origin schemes will enable countries at a country level to make decisions. And again, all those things will just potentially create a green premium. And that green premium is important. Why I'm going on about that is because the economics are challenging.
Still a gap.
There's going to be a gap. So you either get a customer paying more or you bring down your costs on the supply side. And I think we're going to get a bit of both.
Yeah, we might be somewhere in the middle there.
Exactly.
Yeah.
And a lot of these major projects are looking for that. And Asian Renewable Energy Hub's a good example. There's some other big industrial, well-credentialised businesses in Australia which are really going after this. Obviously, Fortescue with FFI, Origin Energy is another one. These are businesses that are very serious about this. They're dedicating real resources to it today. They're starting to move through their feed stage, so their front-end engineering design phase. They're starting to think about capital, which certainly CEFC can play a role there. So I don't think it's too far off, as in it's not 10 years away. I think hopefully in the next 5 years we'll start seeing real projects getting up.
Yeah, very exciting. And just sort of bring you back to the CFC and our role. We have debt and equity. We're more we're green bank like. Arena of course has grant making capability, and there are governments who are trying to support the fledgling hydrogen industry here in Australia. So at the CEFC, how do you see us sort of best supporting this emerging marketplace?
Yeah, we're going to need to use all the tools we have in our toolbox, no doubt about that. And CEFC is a great place because we do have tools in our toolbox. We will use flexible financing. That's not just cost, but certainly cost is an element. I think we'll need to provide what we call concessionality, and the Advancing Hydrogen Fund has been set up to enable that. But we'd also need to provide flexible and innovating financing solutions. And by that I mean some of the challenges I've discussed between that long-term offtake required, how they're competing with the alternative technologies. We might need to come up with some new financing structures to allow for that, and we're certainly up for it. And so we're starting to talk to projects about what they need. And then I think it's also important to note, so the Advancing Hydrogen Fund is very much core supporting hydrogen projects, what we're talking about here, but a lot of the other platforms within the CEFC and where we look to invest are also really important enablers for Australian hydrogen economy. We have a very strong business in renewable energy, and ultimately these costs that we're going on about, to bring costs down, the key cost driver is renewable energy costs. So we need to continue as an industry, as the CEFC, continue to bring down renewable energy costs. That's a key input. And then innovation as well. Yeah. Certainly this deal that was announced today, really exciting. And we're seeing a lot of really exciting innovation coming from Australia and Australian universities and CSIRO and R&D to really that step change in bringing up efficiency of hydrogen production and bringing down costs. So the supporting those enablers are going to be really important.
No, I think that's absolutely right. And, the Innovation Fund is, of course, what the venture capital end. And I think, as you say, there'll be further technologies that'll come, that we'll be looking at, and hopefully we can support them. We've got, our renewable energy practice, which is, we've got a lot of experience there, and we've got a lot of capital, right? We've got $10 billion, and at the moment we've only really got 5 or so out the door. So there's a significant amount of capital. The other thing I'd also say is, we're prepared to take risks that others aren't, because there's no point us. And it's interesting. One of the first questions that came in was how does the CFC ensure it doesn't compete with the private sector here? And I think the more mature technologies, I think that really does potentially become an issue. So someone's building a new wind farm, or there's something kind of quite established. We have to sort of look at that quite carefully. This hydrogen kind of sector, in some cases we're barely, these things are barely commercial. There's lots of risks. They might not have offtake agreements. There's a lot of unknowns in there. I think our role is to take some risks there, sensibly. We're using taxpayers' dollars, but risks that other private investors aren't prepared to take, because that'll help this whole market move along. So. I think there's a lot of exciting ways of working together. And look, as I say, we worked fantastically with ARENA in building out the utility scale solar PV market here in Australia. And I really hope that we might also partner again with our friends at ARENA in the hydrogen space.
Yeah, no doubt. A really important element. All the projects we're seeing at the moment, that grant finance from ARENA, really important. All state governments or both, really important element. And we are working closely with ARENA. They've run around recently where they announced 3 successful projects. We've worked with them closely in the background on that. There's still some more to play out on those projects.
Yep.
So it's a really important part of the mix at the moment where we are. And coming to the question on private sector capital, it's very early in the hydrogen phase at the moment. There's a lot of interest from private sector capital, no doubt about that, from both financiers on the debt side and the equity side. We encourage that. We look forward to investing in projects with private sector capital. The challenge at the moment are the economics, and in order to get the return that private sector capital are chasing. However, I hope that's not too far off, and we'll look to co-invest.
Excellent. Okay, well that's terrific. I'm going to turn to some of the questions, Rupert, that are coming in, and you've got a pretty good response. There's a question here about, and obviously someone's thinking about the CFC's investment mandate and our ability to invest. In terms of our act. I've got a question here. Will the CFC consider investing in blue hydrogen projects?
Unfortunately, blue hydrogen or carbon capture and storage is a prohibited technology under the CEFC Act currently. So a traditional blue hydrogen project would be utilising CCS, carbon capture and storage technology. So unfortunately, we're unable to. Not for us today. There is potentially in the future if there's a change of that act. But at the moment, it's a prohibited technology, unfortunately.
Yeah, no, I think that's absolutely the case. We read a lot about the enormous investment that Germany is putting into the green hydrogen market, billions of euros. What can we do to make sure Australia's not left behind in the international hydrogen conversation?
Yeah, so there's a lot happening globally, and it's really exciting. I don't think we look at it at this stage as going head to head. If we look at Germany as a good example, or Japan or Singapore, these markets where you're reading a lot in the press, a lot of these markets are likely going to be customers rather than competitors. A lot of these markets, Germany is a good example. What I mentioned before, they see themselves as a net importer of energy. They've mapped out their geographic area there within country and their energy needs out at 2050, and they understand that they need to import in renewable energy, and so that's where they're really looking at building these supply chains, and it's exciting. they've recently announced a program, €1 billion, to bridge some of these gaps between imported hydrogen. So coming back to the earlier question, how far away are we? Germany's there, they're putting a flag up saying, we want it soon, and we're putting money on the table. And so they're going to a global process to get bids in from the world, from different projects. I see the Australian projects as being in a good position in that process. And the German government's going to cover some of that difference. So, and Singapore's another, and I see that the federal government quite recently, with Alan Finkel and his new role, are announcing some really key and important partnerships with some of these markets. So I don't purely see it as competition with some of these markets. Some markets that might be more competition over the years, but certainly some of these net importing markets, I see them as being Australian customers over the years. And it's really important to note that we've built a really strong track record importing or exporting from Australian energy for over a long period of time.
Yeah.
We're a strong, low sovereign risk country, and I hear that. I'm hearing that from when you speak to German industrials, and they emphasise that, because you think North Africa's closer, but that they emphasise that relationship with Australia. So it's exciting times.
Yeah, fantastic. Here's a question for project developers beginning to look into hydrogen. What should they be mainly focused on as they are starting to attract project investment?
Yeah, so what we're seeing at the moment, there's a lot of projects underway. A lot of projects are looking at producing hydrogen. The challenge, which I've touched upon, is that, well, the offtake and who are you going to sell it to, and what's the hydrogen going to be used for, and that focus, building a project around that offtake, building a project around that demand. Don't think about it too late. Think about it. Start with that. Start with what you're going to be using the hydrogen for. Certainly, come and talk to us. We will look to develop financing solutions to help if we can, but yeah, really focus on that demand side, I'd say, because the supply and the production side is possible and will come, but a lot of that will need to be built around, well, who am I selling to, how certain, what's the volume I need to sell, and those sort of considerations.
And that's the sort of thing I guess we're seeing in some of the projects that we're looking at the minute, the contracting versus the merchant kind of risk and so on. Because I've got a question here from actually someone I know, a very experienced equity analyst. Over the next 3 to 5 years, based on how you have been informed in this report, what areas does the CEFC see it most likely to invest? Touch a little bit on that, but maybe just to sort of recap for the audience.
Well, I see opportunities certainly in ammonia and gas blending. I think there's some projects spoken about that publicly, and I see opportunities there. The main reason is what I touched on before. You've got a very deep demand pool there. So as I just said, focus on the demand, who you're going to sell to. There's a customer there, and it's a customer willing to buy large volumes. So I see opportunities there. Certainly see opportunities in transportation. I think the report steps that through, that there's a pathway to those areas being commercial in the nearish term. And so we hope to deploy some capital there. Certainly, we want to incentivise those truck manufacturers to start ideally manufacturing or assembling here in Australia. We would love to deploy capital to incentivise that, or at least allocate vehicles to this market from a global perspective, and bring forward that manufacturing. Because then we can see once you solve that, on the customer or on the project side, we see opportunities. There's lots of opportunities. There's lots of customers who are driving around in diesel trucks today who are saying, give me a solution which is close to being the same cost, which is low carbon emissions like hydrogen, and I'm there. And so there's no doubt there's appetite from customers. It's about enabling and giving them solutions.
No, absolutely. Look, last sort of question here. It's I've got we're kind of running out of time. We could spend, I suspect, hours talking about this topic. It's very diverse. And it really is fascinating. Given the high export focus of green hydrogen, what role will government financing play in the development of the industry? I'm sort of going to leave out the CEFC.
Sure.
And it's interesting, maybe I'll make a little comment here that as I kind of go around the country talking, I talk to a lot of the state governments, as I'm sure you do, Rupert. They all, and of course the federal government, independently of the CFC, are wanting to support this hydrogen industry. You must see that, and be it, grant funding, possibly, forms of financing, maybe equity.
Yeah, no doubt. Both at the federal level and at the state level, there's a lot of focus on this support, and it's as you say, it's both money and grants, but there's a lot of other support that they're looking. This hydrogen hub program is really important, and that is ultimately about export long term. Let's produce hydrogen in a location which makes sense, where you can bring around the infrastructure and utilise that infrastructure for multiple end uses in a location that will ultimately be an export location. So that's why a lot of the hubs will be in port locations or close to port locations. And then the state governments are very much doing similar things and working with the federal government, obviously. And helping planning what ports are right for this, long-term planning, where hydrogen plays a role in those port locations, and state governments are looking to help that through this planning phase. So.
Definitely. And look, it's, I think a bit of healthy competition between the states.
No doubt.
Not a bad thing. Not a bad thing. Look, we've run out of time on our hydrogen green room today. It's been terrific. Thank you, everyone, for joining us. I've enjoyed it. I hope you have too. As I mentioned, there is a survey that will appear at the end of the screen. If you get a chance, please fill it out. Otherwise, thank you once again for joining us. Keep an eye out for further green rooms here at the CEFC. Enjoy your day. Thanks very much. Thank you, Rupert.
Thanks.